It happened. 2,700,000 Oz disappeared overnight. Run on the bank. It happened. 700,000 Oz disappeared overnight. Run on the bank. 2.7 million ounces gone. Not stolen, not misplaced, withdrawn. In a single night, one of the world's most secure vaults emptied. The institution said nothing. The media reported nothing. Someone knew something the rest of the world didn't. Someone with enough power, enough capital, enough inside information to move first. While everyone else slept, they acted. The question isn't what disappeared. The question is, who took it, and what do they know that you don't? Welcome to Financial Inspection. If you've been in business long enough, you know when something doesn't add up. Do us a favor, hit that subscribe button, the way you'd mark an important document for review, and tell us, where are you watching from today? Let's get to the bottom of this. On a quiet Tuesday evening in March 2024, something unprecedented occurred in the precious metals market. Inside one of the world's most secure depositories, 2.7 million ounces of silver vanished from the registered inventory. Not stolen, withdrawn. In less than 24 hours, the equivalent of 84 tons of physical metal was removed from the vault and transferred to unknown parties. The institution in question was a major COMEX-approved depository, the same type of facility that backs exchange-traded funds, futures contracts, and countless paper claims held by investors worldwide. The same vaults that assure millions of investors their silver is safely stored and fully allocated. But here's what made this withdrawal different. This wasn't a gradual drawdown over weeks or months. This was a surgical extraction. Someone, or some entity, didn't just want silver. They wanted it immediately. They wanted it physically. And they had the credentials, the capital, and the urgency to move mountains of metal in a single operation. The official inventory reports showed the numbers. Registered silver at this facility dropped from approximately 3.1 million ounces to just 400,000 ounces overnight. A reduction of 87% in eligible for delivery inventory. The market barely noticed. No headlines, no emergency announcements, just a footnote in the daily COMEX inventory report that most traders never read. But sophisticated players noticed? Because in the world of physical commodities, inventory doesn't lie. Paper contracts can be printed endlessly, derivative positions can be leveraged 30 to 1. But physical metal occupies space. It has weight. It requires transport, security, and most importantly, it requires actual existence. When 2.7 million ounces moves, it means someone stopped trusting the paper system. Let's understand the scale. 2.7 million ounces represents roughly 10% of the entire COMEX registered silver inventory at that time. In a market already running historically tight inventories, this withdrawal created a seismic shift in available physical supply. Not theoretical supply, not paper supply. Actual deliverable metal. The mechanics of the withdrawal revealed even more. This wasn't a retail investor asking for their 100 ounces. This required multiple armored transports, advanced logistics coordination, verified storage destinations, and most critically, prior approval and settlement of all custody arrangements. These operations don't happen spontaneously. They're planned. They're authorized. They represent institutional scale decisions made at the highest levels. Whoever executed this withdrawal had done their homework. They understood the difference between allocated and unallocated metal. They knew the risks of holding paper claims versus physical possession. They had assessed counterparty risk and found it unacceptable. So they acted, not with panic, but with precision. Now, compare this to historical patterns. In 1968, the London gold pool collapsed when physical demand overwhelmed paper promises. Central banks had been selling gold to suppress prices, but eventually the physical metal ran out. The system broke. Those holding paper claims discovered their contracts meant nothing when vaults were empty. In 1980, the Hunt brothers attempted to corner the silver market. The system changed the rules mid-game, moving to cash settlement instead of physical delivery. Those expecting metal received paper checks instead. In 2008, during the financial crisis, investors rushed to convert paper gold claims into physical metal. Delivery delays stretched from days to months. Some contracts were forcibly cash settled. The gap between paper price and physical availability became undeniable. The pattern repeats. When stress enters the system, paper and physical decouple. Those who move first get metal. Those who wait get promises. And sometimes promises are all that's left. This 2.7 million ounce withdrawal wasn't random. It was a warning shot. Someone with substantial resources and insider understanding of market mechanics decided the risk of holding paper claims outweighed the cost and complexity of taking physical delivery. They saw something in the data, the leverage ratios, or the counterparty chain that made immediate action necessary. For business leaders and entrepreneurs, this event raises fundamental questions about asset security. If sophisticated institutional players are demanding physical delivery, what do they know about system stability that retail investors don't? If a single large withdrawal can remove 87% of deliverable inventory from one facility, how fragile is the entire supply chain? And most importantly, how many other paper claims exist against metal that may no longer be available for delivery? The disappearance of 2.7 million ounces overnight wasn't the story. The story is what it revealed about the system itself. Most people believe that when they buy silver, they own silver. They don't. What they own is a promise, a contract, a claim on silver that may or may not exist in the quantity they think it does. And this isn't a conspiracy theory. It's how the modern precious metal system is deliberately designed to function. Let's pull back the curtain. Imagine a bank that takes deposits. A customer deposits $100. The bank doesn't keep that $100 in a vault with the customer's name on it. Instead, it loans out $90 to someone else. The bank now has created claims on $190, but only $100 actually exists. This is fractional reserve banking. Everyone learns this in economics class. Now apply that same structure to precious metals. A depository holds 1 million ounces of physical silver, but it issues claims, certificates, and contracts representing 10 million ounces, or 20 million, or more, as long as only a small percentage of holders demand physical delivery at any given time. The system functions smoothly. The depository collects storage fees. The metal gets leased to industrial users. The same ounces back multiple paper claims simultaneously. This is called unallocated storage. In an unallocated account, the investor doesn't own specific bars of metal. They own a general claim against a pool of metal. The depository can lease it out, sell it, move it, use it as collateral for other transactions. The investor sees a number on a statement and assumes their metal is sitting safely in a vault somewhere. It isn't. Their claim is sitting in a database. The actual metal might be in London, or it might be leased to a manufacturer in India, or it might be backing 3 other investors' claims simultaneously. The investor has no way to verify, no inspection rights, no serial numbers, just trust in the institution's bookkeeping. Allocated storage is different in theory. In allocated accounts, specific bars with specific serial numbers are supposedly assigned to the account holder. The metal cannot be leased or lent. It sits segregated. But even here, problems emerge. Because how many investors actually travel to the vault to verify their bars are present? How many even know their serial numbers? How many have read the fine print in their custody agreements about what happens during extraordinary circumstances? Very few. Now add derivatives to this structure. Futures contracts allow traders to control vast quantities of metal with minimal capital. A single contract might represent 5,000 ounces of silver, but the trader only needs to post margin of perhaps 10%. So with $5,000, they control a position worth $50,000 or more. Leverage multiplies. Most futures contracts never result in physical delivery. They're cash settled. Traders profit from price movements without ever touching actual metal. This creates a massive paper market that floats above the physical market, sometimes with ratios exceeding 100 paper ounces for every physical ounce available. Exchange-traded funds add another layer. An investor buys shares in a silver ETF, believing they own silver. But what they really own is a share in a trust that claims to hold silver. The trust has a custodian. The custodian has sub-custodians. The sub-custodians have allocated and unallocated accounts. The chain of custody stretches across institutions, jurisdictions, and legal structures. At each link, counterparty risk multiplies. Read the prospectus of most precious metals ETFs carefully. Hidden in the legal language is a critical disclaimer. In certain circumstances, the fund may settle in cash rather than metal. The fund may use futures contracts or other derivatives instead of physical holdings. The custodian's obligations may be limited. Authorized participants who create and redeem shares have privileges that ordinary investors don't. The system works beautifully until it doesn't. In 2008, investors discovered that tungsten-filled gold bars had been circulating in the system for years, fake bars with genuine serial numbers and certifications. Because verification is expensive and rare, counterfeits can persist undetected. Trust breaks down when people actually check. In 2020, during COVID lockdowns, the COMEX futures market faced a crisis. Traders holding contracts demanding physical delivery found that logistics breakdowns made delivery nearly impossible. The exchange changed rules midstream. They created new contract specifications, allowing delivery from different locations with different quality standards. The system adapted, but only by changing the terms of existing agreements. This reveals the core vulnerability. When multiple parties hold claims on the same physical assets, the system depends entirely on most people never demanding settlement simultaneously. It's musical chairs with metal. As long as the music plays, everyone assumes their chair is waiting. But when the music stops, the mathematics become brutal. If a depository holds 1 million ounces but has issued claims on 10 million ounces, only the first 10% who demand delivery will receive metal. The rest will receive explanations, delays, legal notices, force majeure declarations, cash settlements at prices determined by the institution, not the market. The 2.7 million ounce withdrawal that happened overnight didn't break the system, but it exposed how the system actually functions. Someone with the knowledge and resources to navigate the custody chain, verify actual holdings, and execute large-scale physical transfer decided that paper claims weren't sufficient. They demanded metal, and because they moved decisively, they received metal. The question for every business owner, entrepreneur, and investor is simple. Do you own assets, or do you own promises? And when stress tests the difference, which side of that equation will you be on? Someone knew. While the rest of the market slept comfortably, assuming their investments were secure, someone had done the calculation. They had run the numbers. They had seen the leverage ratios, studied the custody chains, and reached a conclusion that demanded immediate action. This wasn't panic, this was precision. The withdrawal of 2.7 million ounces was executed by a nervous retail investor checking their portfolio at midnight. This was institutional scale decision-making, the kind that requires board approvals, legal reviews, logistics coordination, and significant capital allocation. This was someone who understood exactly how the system works, and exactly why they needed to exit it. But who? The depositories don't publish client names. Privacy agreements protect the identities of large holders. But the profile of the actor can be constructed from the behavior itself. First, consider the scale. 2.7 million ounces of silver represents approximately $125 million at market prices during the withdrawal period. This isn't billionaire hobby money. This is institutional treasury allocation, pension funds, sovereign wealth entities, family offices managing generational wealth, corporate treasuries hedging currency exposure. These are the players operating at this magnitude. Second, consider the timing. The withdrawal happened during a period when official inflation data showed stability, when central banks were assuring markets that monetary policy was under control, when mainstream financial media was discussing soft landings and controlled economic adjustments. Yet someone looked at the same data and reached the opposite conclusion. They saw something others missed, or they had access to information others didn't. Large institutional players operate with advantages that ordinary investors never see. They have relationships with vault operators. They can request physical audits. They can inspect serial numbers, verify assay reports, and confirm chain of custody. They can afford the legal expertise to parse custody agreements and identify escape clauses that might trap less sophisticated holders. They also network with each other. When one sovereign wealth fund starts taking physical delivery, others notice. When a major pension fund shifts from paper claims to allocated storage, conversations happen at conferences, in private meetings, in encrypted communications that never reach public channels. Information moves through these networks faster than through public markets. This creates a cascade risk. The first mover has an enormous advantage. They demand delivery when inventory is available, when logistics are manageable, when the system has capacity. They get their metal, they secure their position, they sleep well, knowing their assets are under their direct control. But their movement triggers awareness in others. A second institution notices the inventory drawdown. They review their own positions. They realize they're holding similar paper claims against the same shrinking physical inventory. So they act. They demand delivery. The inventory drops further. Now a third player notices. Then a fourth. Each withdrawal makes the next withdrawal more urgent, because the mathematics are unforgiving. If 10 entities hold claims on the same million ounces, the first entity to act gets metal. The second entity gets metal. The third might get metal. But the 7th, 8th, 9th, and 10th entities will not. They'll get apologies and legal documents explaining why their claims cannot be honored. History demonstrates this pattern repeatedly. In 1968, the London gold pool collapsed precisely because central banks and large holders began demanding physical gold instead of accepting paper claims. Once the movement started, it accelerated. The pool drained. The system broke. Those who moved early preserved their positions. Those who waited lost. In 2011, investors in the MF global bankruptcy discovered that their supposedly segregated commodity accounts had been raided to cover the firm as trading losses. Client assets that were meant to be untouchable were gone. Those who had demanded physical delivery before the collapse were protected. Those who trusted the system lost everything. The pattern is consistent. Large, sophisticated players move first because they have better information, better analysis, or better advisors who understand structural risks. They act quietly, without announcements, without explaining their reasoning to the public. They simply execute. And by the time the general market realizes something has changed, the opportunity to follow them has already closed. So who withdrew 2.7 million ounces? The specific identity matters less than the category. This was an entity with resources to execute large-scale physical settlement, knowledge to understand the difference between paper and physical exposure, information suggesting that paper claims were becoming unreliable, authority to make rapid decisions without committee delays, and most critically, urgency, indicating they believe time was running out. This could be a sovereign entity preparing for currency instability. It could be a pension fund whose risk managers identified counterparty exposure that exceeded acceptable levels. It could be a family office whose advisors saw the same warning signs that preceded previous financial dislocations. It could be a corporate treasury protecting shareholder value against monetary debasement. What matters is the signal their action sends. When entities of this caliber take physical delivery, they're voting with their capital. They're declaring that the risk of holding paper has exceeded the cost of taking physical possession. They're saying that trust in the system has eroded to the point where verification is mandatory. For business leaders watching this unfold, the implications are stark. If those with the best information, the best advisors, and the most resources are demanding physical delivery, what does that say about the stability of paper claims? If institutional players are quietly exiting positions that appear safe on the surface, what structural problems have they identified that aren't yet visible to the general market? The actor who withdrew 2.7 million ounces overnight had an advantage. They knew something, they acted on it, and they secured their position before anyone else realized the game had changed. The question isn't who they were, the question is, what did they see? And is it already too late for everyone else to follow? The metal is gone. 2.7 million ounces removed from the system in a single night. But the real story isn't what disappeared. The real story is what remains, and who's left holding claims against it. This is where mathematics becomes merciless. When fractional reserve systems face redemption pressure, there are only two possible outcomes. Either the institution honors every claim with physical delivery, or the system breaks. There is no middle ground. And when the claims exceed the physical assets by factors of 10 or 20 to 1, the outcome is predetermined. Someone will not get their metal. For business leaders and entrepreneurs, this event serves as a wake-up call about asset verification in every category. Not just precious metals, but any asset where paper claims can be created more easily than physical assets can be produced or delivered. Consider the parallels. A business holds cash in a bank account. The statement shows a number. But that number represents a claim on the bank, not physical currency sitting in a vault with the company's name on it. If the bank faces a run, if depositors demand withdrawal simultaneously, the bank may not have sufficient reserves. Deposit insurance exists for this reason, but insurance only covers specific amounts under specific conditions. A company holds shares in its brokerage account. The statement shows ownership, but the shares exist in street name through the depository trust company. Multiple parties may have claims on the same shares through lending, rehypothecation, and derivative positions. In extreme market stress, settlement failures have occurred. Shares that were supposed to be there weren't. A manufacturer depends on commodities for production. They hold futures contracts as a hedge. But when they attempt to take physical delivery, they discover that the exchange has changed delivery terms, imposed cash settlement, or declared force majeure due to supply disruptions. The hedge that was meant to protect them fails precisely when protection is most needed. The pattern repeats across asset classes. Paper claims work smoothly until everyone tries to convert them into physical assets simultaneously. Then the illusion shatters. And those who waited, who trusted the system, who assumed their statements represented reality, discover they were participating in a game of musical chairs where the music just stopped. So what should business leaders do with this information? First, conduct an asset verification audit. Every position the company holds should be examined not for its paper value, but for its actual accessibility under stress conditions. Ask the hard questions. Can this be converted to physical possession? What are the settlement terms? What happens if the counterparty fails? What are the contract clauses that allow forced cash settlement or delivery substitution? Most companies never ask these questions. They trust statements. They assume institutions will honor their obligations, but trust is not a business strategy. Verification is. Second, understand custody structures. There's a hierarchy of ownership security. At the top is direct physical possession under the company's control. Next is allocated storage with specific identification and regular audits. Below that is unallocated storage where assets are pooled. At the bottom is paper claims backed by derivatives or promises. Each level down this hierarchy introduces additional counterparty risk. In calm markets, the differences seem academic. In stressed markets, these differences determine survival. A business holding physical inventory in its own warehouse has full control. A business holding allocated gold in a third-party vault depends on that custodian's solvency and honesty. A business holding shares in a gold ETF depends on a chain of custodians, sub-custodians, authorized participants, and derivative counterparties. Each link is a potential failure point. Third, recognize the timing advantage. The entity that withdrew 2.7 million ounces didn't wait for a crisis. They moved before the crisis became obvious. By the time problems become visible to everyone, the opportunity to take protective action has usually closed. Vaults are empty. Delivery queues are months long. Premiums on physical assets have exploded. The cost of protection has become prohibitive. Strategic positioning means acting when action seems unnecessary. When markets are calm, when inventory is available, when counterparties are stable, because once stress enters the system, options narrow rapidly. Fourth, calculate the mathematics of your exposure. If a company holds positions in any asset class where leverage is common, run the numbers. How many claims exist against the available physical supply? What percentage of holders would need to demand settlement before the system breaks? Where does the company stand in that queue? For precious metals specifically, various analysts estimate that paper claims exceed physical inventory by ratios ranging from 10.1 to over 100.1, depending on how derivatives are counted. Even using conservative estimates, this means that if just 10 or 20% of holders demand physical delivery, the system cannot honor all claims. A company positioned at the end of that queue will not receive metal. They'll receive explanations. Fifth, diversify custody and jurisdiction. Large institutions don't keep all their assets with a single custodian or in a single jurisdiction. They spread exposure across multiple entities, multiple locations, multiple legal frameworks. This provides protection against individual institution failure, regulatory seizure, or jurisdiction-specific problems. A business holding all its precious metals with one custodian in one country has concentrated risk. If that custodian fails, or if that jurisdiction imposes capital controls or delivery restrictions, the entire position is at risk. Sixth, understand that the system can change rules mid-game. History shows repeatedly that when stress threatens major financial institutions, authorities change the rules to protect the system rather than individual participants. Contracts are modified, settlement terms are altered, cash settlements are imposed instead of physical delivery. Capital controls are implemented. These aren't theoretical risks, they're documented historical events. In 1933, Executive Order 6102 required U.S. citizens to surrender gold to the government. Private contracts were overridden. In 1980, COMEX changed margin requirements and position limits to break the Hunt brothers' silver position. In 2008, short-selling bans were imposed in various markets. Rules changed when the system was threatened. Business leaders planning for all scenarios must recognize that the legal framework protecting their positions today may not exist tomorrow. Contracts that seem airtight may be declared void under emergency powers. Assurances that seem solid may evaporate when protecting them would threaten larger institutions. This isn't pessimism. This is realism based on historical precedent. The strategic response framework comes down to a simple principle. Verify what you own, understand where it is, know who has claims on it, calculate what happens under stress, and position accordingly before stress arrives. The entity that withdrew 2.7 million ounces understood this. They didn't wait for confirmation. They didn't wait for headlines. They didn't wait for official warnings. They saw the structural vulnerability. They calculated their exposure. And they acted. Now, the question facing every business leader is equally simple. Will you verify your positions while inventory is available and settlement is possible? Or will you trust paper promises? Until the day you discover that trust was misplaced. The metal is gone, but the lesson remains. In any system built on fractional reserves and leveraged claims, those who move first preserve their positions. Those who wait discover that their claims were always conditional. And the conditions just changed. This is not a prediction. This is pattern recognition. And the pattern has repeated throughout financial history with mathematical precision. The only variable is timing, and for 2.7 million ounces, that timing was overnight.